Welcome to another episode of the Doctors Building Wealth podcast. Today, Kenji and I wanted to talk about being in a real estate downturn. So we've done podcasts before, we've written articles before, and talked about what you can do to prepare for a downturn. And while we're currently not in a downturn in the stock market, we certainly have been in a downturn now in real estate at least a year or two. And we wanted to talk about what you could be doing right now in real estate investing, given that it is a downturn, to be able to really grow your wealth during this period, because this is one of those times where opportunities are so much more plentiful and you have the real chance to grow your wealth significantly when there's a recession. And this real estate recession is no different.
Yeah, and I wanted to talk about that real briefly, which is that a lot of people might actually say, well, things are going real well. This doesn't feel like a downturn. And if you were investing back in 2008, this definitely doesn't feel like that downturn. Mm-hmm. That was a true, deep real estate downturn that I lived through. And this is very different, but it is a downturn nonetheless. And I think the thing that probably triggered it the most is the inflation that happened and also the interest rates going up. And that just put a freeze to all activity in real estate. I was looking at some statistics, and buying activity declined significantly right after the interest rates went up. And also sellers stopped actually listing their properties. So there were very few properties out for sale as well. And so a lot of people have been sitting on the sidelines, both sellers and buyers. And that's pretty much a downturn because there's so little activity relative to normal times and also relative to a boom.
Yeah, and I think what we think about when we think about a recession or a downturn is we think about prices going down. But what was so, different about, 2022, 2023 is prices weren't changing because no one would sell and no one would lower the prices because they were used to what was going on in 2021. Whereas in the last 2 years or so, now prices have come down. And now a lot of people who had loans that had 4 or 5 year or 3 year terms are getting into really difficult situations. Maybe they had floating rates, maybe they didn't, but either way they have to refi. And they're in this situation that values have come down and they're needing to go and sell. And so what that means is there are more and more opportunities to buy properties at a discount. And that feeling for sellers of, I'm going to have to sell this property for less than I bought it for 5 years ago, it's a terrible feeling for sellers. And for buyers, it's such a boom because it's like, oh my gosh, I'm going to get a really incredible discount and I'm in the driver's seat to be able to get a lot of immediate appreciation. So immediate appreciation is when you buy that property at a discount, and you're not buying at a discount necessarily even today, but you're buying at a discount compared to where it's going to be in a couple of years, right? Everything runs in cycles, and where we are right now is much more discounted than it was a couple of years ago, and it's at a lower price than it will be a couple of years from now. Nobody exactly knows when that will happen, but it will come again where there will be an uptick in the market and things will go higher. And so you can imagine if you bought a huge portfolio right now in this timing in the market, what it's going to be worth just down the road.
Yeah, and I wanted to talk about sellers for a little bit and what the dynamic has been. Almost put yourself in the shoes of a seller so you can kind of imagine what's been going on in the mind of a seller. And I think what sellers have been doing is, because interest rates essentially doubled, and what that does is it puts a lot of downward pressure on pricing. And so you're not able to sell your property for as much as you thought. And I think the other problem is that if you do sell, then you have to buy a new property and you have to finance into something that's much higher than your current interest rate. So people have been holding on to their properties. They haven't listed them, and they really haven't wanted to sell them for less than they think it's worth, or less than it was worth back in 2022 or 2021 before the interest rates doubled. And so that's the mentality. They're kind of holding on and they're hoping for interest rates to go down. They're hoping that buyers have an appetite to pay more, but it really hasn't been happening. And so what we're finding is that sellers who have been holding out, ultimately a lot of them aren't able to hold out any longer. And so they're having to sell. Some of it is driven, like you said, by the fact that their loan terms are ending. Others are maybe getting older and they're just like, I can't hold out anymore. I need to make a move. I've stayed in the same place for a long time, and I need to make that move, right? I need to go live my life, right? And so people are now starting to sell, and there really are, as you said, Leti, there really are values out there earlier this year, we bought a property that was out there for 21 million. Oh, let me step back. The buyer had bought it for 18 million. Mm-hmm. They put 3 million into it. So they were all in 21 million. And we were able to buy that property for 11 million. And there were a lot of factors involved in that, but part of it was the seller kind of hit a point where they were closing their fund. This was like the last property in their fund. They had to get rid of it. And so it really was a timing thing. They held out for as long as they could, but it just got to a point where they were like, okay, we got to sell this property. And we happened to be there, right place, right time, to be able to pick up an incredible deal.
And great connections.
That's right, great relationships.
It's always about relationships in real estate investing. I think I want to mention two other things. Number one is you hear a lot about the baby boomers, right? And the transfer of wealth that's going to happen over the next 10 years. And you oftentimes hear about it in businesses and, in general businesses like dry cleaners or gas stations or car washes or whatever. But you don't think about it as much in real estate investing. But that's what Kenji's describing is there is a transition where a lot of baby boomers own large portfolios that they've been building up over the last 50 years. And maybe their family doesn't know anything about real estate, or maybe they actually need the money, right? They need the money. They're going to go into a nursing facility, or they have other costs that are coming up and they want to liquidate their portfolio, or maybe they're even self-managing, right? And that's a lot for someone in their mid-80s to be self-managing. And so we're seeing deals come up also because people are just in different transition points in their lives with their ages, and they're moving out of those properties. So just remember, when you hear about the transfer of wealth with baby boomers, a lot of that's actually real estate too.
Now, you may have heard this, and this is actually something that we talk a lot about, but we tell our people who are thinking about getting into real estate investing, what you want to do is you want to be prepared for a downturn and really build up your skills, build up relationships, so that when a downturn comes, you'll be there ready to pick up incredible deals.
And one other point I wanted to make was that different markets will be affected differently. So it may be more intense, the discounts in one market versus another. And so you just need to be aware this is not going to be the same amount of drop across all the different markets now. There may be better deals in some places and not so good deals in other places, depending on where the population's moving and what's happening with local economics, right? So just thinking about where the population moving, maybe you might not get as many discounts maybe in Florida as you might get somewhere else where the population's moving out. So just understand that, we're talking very broadly about getting immediate appreciation and what's going on across the markets, but within a single market, things may be slightly different.
So now that we all agree that we're in a downturn, the real question is, now what?
Yeah, and so some of the things that we've talked before, we want to bring back and talk about how they apply right now. So one of the things we've talked about before is how we continue to buy through every market. So given this situation, this encourages us to buy even more. That's what's different. So when there are discounts, like he was just talking about, a discount where somebody really had 21 million in value in a property and they were willing to sell it, for almost half of what they had in it, that's an incredible opportunity, right? And as long as you can maintain the rents, as long as you're going to be able to be cash flowing, which really you should be with that kind of discount, then you can afford to hold this property for the long term. And when the market comes back, it's going to put you in such a great situation. So thinking back to 2021 and thinking about how at that time there were many different bids and you'd bid up and you might not get immediate appreciation. Now we literally buy at such a discount that cash flow is easier, but also it's hard to lose money when you buy at a discount like this, because knowing what markets do, if you can just wait a few years, you're going to be in such a different situation down the road.
Yeah, this is such an interesting market, though. Something I wanted to talk about is what I don't really see is I still see a lot of people sitting on the sidelines, and I don't think it's because of the reasons that we had in 2008 where there was a lot of fear, right? I don't think it's necessarily fear-based. I actually think part of the reason why people are still sitting on the sidelines is that the stock market's doing really well, and it's just so interesting to kind of see. I think that's one big driver. What people aren't realizing is there are really great deals out there. I think part of the other issue is that, since the stock market is doing well, in order for them to invest in something, they are going to have to take that money out, right? Mm-hmm. Maybe pay a capital gain and then put that money into real estate. And maybe the other part of it is that they don't realize that there are such great deals out there right now. But if you're listening to this, you want to make sure you understand that we're in a real estate downturn. And so there are deals out there. So this is really the time to get in there and get those great deals.
Right, and those great deals are with immediate appreciation, but you still want to stack all the other returns on top of that, right? You still want to cash flow, you still want to force appreciation, you still want to take advantage of all those tax benefits. You want to do all those pieces to reduce risk, increase your cash flow, increase your return, all those pieces as well. But it's just that the opportunity for immediate appreciation is larger than it's been in a long, long, long time. So one question to ask then, would you consider tightening your criteria, right? Tightening your criteria, maybe even aiming for higher cash on cash return in this type of market?
Yeah, and I think I would. I would actually aim for even better deals in this market, because the way I've always thought about it is when there are lots of deals out there, and I think, again, there are lots of deals out there right now, I think the good deals are going to the average investors or the beginners, right? I think that the really good investors, the top investors, most experienced investors, have access to the greatest deals, the best deals, right? So I think I would tighten my criteria. I probably would really aim for that really great deal. Like you said, all the other fundamentals, tax benefits and forced appreciation and cash flow, all those remain the same. But in terms of immediate appreciation for sure, I would be going for more.
So one of the keys to be able to get those really phenomenal deals is to broaden your relationships. So this is something we also have talked about in the past is, when a recession comes, you want to have all those relationships in place, all those teams built, so you get access to more deals. And so this is the time, like if you're only in one market, this is the time to spread your relationships into more markets, or to go much deeper with your level of relationships in that market and broaden even within that market, because your goal is to see as many great deals as possible and have lots and lots and lots of choices. In a market like this, you should have lots and lots of choices. And then you're in a position of strength to be able to really cherry pick those best deals like you're talking about, negotiate really hard, especially if you know the exact position of the seller and they really desperately need to sell. That's just a phenomenal amount of leverage that you have as the buyer to be able to negotiate even more immediate appreciation up front.
Yeah, and I want to talk about relationships real quick, because I think it's really important to develop relationships. And you might be listening to this going like, well, what do you mean by relationships? What kind of relationships? And I want to kind of clarify that. So first off, for sure, you want to build your team, right? You want to have a great real estate agent. You want to have property managers, contractors, all those types of people right now, I think, are more available than they were back in when it was really competitive back in 21 and 22. And so this is the time to really build those types of relationships, because they're kind of hungry, right? There's not as much activity, there's not as much selling, there's not as much buying. So real estate agents are pretty hungry.
They've been hungry for a couple of years now.
They have been. Really. So they really appreciate somebody who is actually still buying in a market like this. And so I would definitely focus on that. But the other type of relationship that I really encourage you guys to really think about is expanding your relationships of other investors in different markets. As you said, if you really want to expand your opportunities, you want to be able to reach into all these different markets across the country. And you want to know investors in the best markets, like Leti's saying, there's different markets all across the country. It's a big country, different pockets of opportunity all across the country, some better than others. And so, yeah, you really want to think about expanding who you know across the country, who could actually be a source of deals, or maybe even a partner or two, right? Somebody you can team up with and take down those bigger properties.
And while you were speaking, I was also thinking about the other people that you work with, the other relationships that you have, for example, contractors, and how much hungrier contractors are right now too. One of the things that recessions do is they really weed out the weakest in anything, right? And so that's why economists, if you talk to economists, they actually say recessions are necessary and actually good. Because when recessions hit, the weakest businesses, the ones that have been able to make it through and do okay when times are really good, are actually weeded out. And that means that only the best remain. And so the situation is going to be the same here for all the vendors as well, those relationships that you have. The best real estate agents are still going to do well. A lot of real estate agents will be weeded out. Same with contractors. And so what's so cool in this kind of environment is only the best are going to survive. And so it's going to get easier and easier to find those people who are better at running their contracting businesses and at delivering results, because they're the ones who lost the customers last, right? Because the customers were like, well, this person didn't really perform. Let me go to this one who's better. And all of a sudden, those really great businesses, they become more concentrated. And so it's actually easier. You deal with less riffraff in the end of businesses and services as a real estate investor during tough times like this.
Yeah, well, it really brings up the question, like if somebody is listening to this and they're brand new, what would you say to them? Is it still possible for them to jump in, build those relationships, and get access to these great deals?
I mean, listen, one of the beautiful things about being high income earners and being physicians and having these W-2 jobs that are rather recession proof is that we have the opportunity to still get loans. A lot of people in real estate investing don't have the opportunity to get loans anymore. So the number of buyers have gone down tremendously. So it's actually an opportunity for you, even as a new investor, to get some attention from a real estate agent who maybe wouldn't have paid you the time of day 3 years ago when things were so hot and they already had a list of 50 people buying and actively looking for the same deals. Now you kind of stand out. You come to them and you say, I can still get loans and I'm still buying. And they're excited to see you. So I think it's a really good time to be able to create relationships, even as a new investor. But again, follow the fundamentals. Know what you're doing. Know how to do a cash on cash. Be able to make your own decisions. Don't rely on them to make the decisions. And come to them and don't waste their time, right? Because what people dislike, real estate investors dislike, is they dislike tire kickers who are coming to them, don't know anything, ask a lot of questions, spend a lot of their time, and then disappear. And so that's what they're always screening for. So you have to come prepared. You have to understand what you really want. You want to have a vision. You want to understand, and have the skill sets to be able to do analysis, to be able to be a real thought partner, and to be able to lead and drive the growth of your portfolio alongside all of your relationships and all of your team members. And so that's still important, is you don't just come with a I don't know anything, I'm completely a newbie, and you're not able to actually follow through and do any of the analysis, because then they will see you as tire kicker, and whether it's a hot market or a cooler market like it is right now, they're still not going to pay you any attention.
Yeah, I totally agree. I mean, this is a chance for somebody new to really accelerate the growth of their real estate portfolio, and faster than, like, let's say in a competitive market. If you're just starting in a competitive market, things may actually be a little bit slower for you to actually accomplish things because you're competing for agents or you're competing for deals. And now, though, as Leti was saying, I mean, it's the opposite. I mean, things are, people are available. There are deals out there, right? So this is a great opportunity to jump in and really, really expand those relationships. One relationship I really wanted to talk about, in addition to other investors and in your team, like agents and property managers and contractors, is banking relationships. And I think that's the other one that is absolutely essential for you in any environment. But I think it's especially easier to build those relationships now, where banks too are oftentimes tightening or they're not doing as much business. But if they find a really good deal and they find a really good investor who's behind that deal, they're happy to fund those deals, right? And so this is a great chance for you to really build your track record, your reputation with these lenders. And just imagine when things are booming, right? Everybody's going to be wanting to get in the door with these banks, and you've already kind of established yourself.
Yeah, I saw a post in Empire Builders, which is our membership community today, and the person was saying, well, I already have Bank of America, so I don't need any other banking relationships. And that is totally untrue, okay? Bankers and relationships with local bankers, with credit unions, relationships with commercial brokers, there's no better time to have those than in a downturn, right? Because if you have that seasoned relationship, if you have some money in their bank, that's going to get you access to loans where maybe other people can't get loans. And that's going to make the difference between being able to buy that really great deal when things get worse, if they get worse, or not being able to get access to the money to buy that deal. And so it is such an important thing to not just say, oh, I have Bank of America. No, you need to go to those local banks, local to your properties and local to you, and make relationships with the presidents of those banks, right? And maybe put in some money, right? And start seasoning that relationship. You have that money in there 6 or 12 months. Now you're really obviously a customer, right? And if you have more money to put in there, that's even better, right? But at least put some money in there. If you don't have a HELOC on your property right now, this is the time to, get that HELOC set up. You may not need it right now, but you may need it in 6 months. So you really want to have access to money, especially if things get worse. that's going to be really even more opportunity. What you're going to be limited by is your ability to buy things and have the funds to be able to buy them, right? It's not going to be a minimum of deals. It's going to be a minimum of the money you have to buy those deals. That's going to be your problem to solve at that point. So start thinking about how to solve that now. Start creating those relationships with those bankers. You need access to cash. You need access to be able to get financing, and starting those relationships now is imperative.
Yeah, I think what most beginning investors don't understand is some of the best deals are creative deals, right? Deals that are not standard, not ones where a Bank of America or Wells Fargo is going to fund. It's going to be a local community bank who's going to sit down with you, look at your business plan and go, okay, I see what you're doing here. I believe in what you're doing. I believe in your vision for this property. Okay, I'm going to lend you the money for the purchase and the renovation. And at the end of it, it's going to become something that's worth a lot more, and then we can refinance, right? And so that's what you're looking for, is you're looking for creativity, right? You're like creativity in lending. And the problem is that most lenders out there are going to be just looking for standard properties, properties that are easy to finance, not something more complicated. Again, that's where that local community bank or credit union, that relationship is essential for getting that really, really great deal.
Mm-hmm. The next one is investing in your existing properties. So if you have a portfolio already, and we're in this recession, and let's say it's not going to get better for the next few years, what you really want to do right now is make your existing properties the best properties on the block, because that's going to allow you to keep your tenants. That's going to allow you to not have to make rent concessions. If rent concessions, all the people around you start doing that. If you're a neighborhood of other properties, you want to be the best property on the block. You want to be the nicest property. You want to be the property where your tenants don't want to leave. Or if they do leave, that you can very easily get another tenant, right? Because in times of recession, when people lose their jobs and they're no longer able to pay, you want to be able to still attract tenants who have jobs, and you want to be able to actually bring in new people instead of having vacancy for long periods of time, which is really going to affect your cash and cash return.
Yeah, and another angle there that I wanted to talk about is the other reason why you want to really improve your properties is you may come across an amazing opportunity, right? A really great deal that you can maybe 1031 into, right? So what you want to do is you want to get your portfolio and force as much appreciation and build up as much equity in those properties, and that allows you to 1031, right? We talked about in a downturn where there's downward pressure on prices, but if you're forcing appreciation, if you're kind of increasing the value of the property by adding a couple bedrooms or a bathroom and transforming the property into something different, now you're actually, even in a downturn, you should be able to appreciate that property and build equity in it. Now you'll have more equity for that bigger property. That's the reason why you want to be prepared for that. You don't know what deal is around the corner, but again, you want to be prepared for the possibility that there's going to be this great deal around the corner that you want to buy, but you don't want to be limited by the fact that you don't have that money in the bank account, right?
Yeah.
That money could come from that equity in the property that you have.
Yeah, and I want to mention that, during the 2008 crash, when things were horrible with real estate, Kenji was actually able to force appreciation. He had an 8-plex at that time. He was forced appreciation and actually sell it in 2009 for even more. So one of the cool things about commercial properties, 5 units and above, is usually you're getting bought by an investor who really is valuing that property based on the cash flow. And so if you can make that property more valuable, make it produce more cash flow, you really can force a lot of appreciation. You can make the value increase by hundreds of thousands, if not sometimes millions of dollars. And yes, maybe you're selling it in a market where you don't get the returns that you would have gotten in 2021. But what it allows you to do is sell that property still at a really great price that's, a substantial profit from what you bought it at, including, all the money you spent on the rehab, and be able to transfer it into that next property that you got a ton of immediate appreciation on because you got it at a cheap price. So that's another argument for really optimizing what you currently have, beyond just strengthening the cash flow, putting yourself in a better situation, making sure that you're attracting tenants when things get harder. If the stock market goes down, or there's, the whole market goes into recession. And with short-term rentals, I want to make a note too. If you have a short-term rental that's in a traditional vacation market, if we go into a stock market recession, right, where people are losing their jobs and things are really tightening up, then you really need to be mindful that people may limit the amount that they're spending on things like vacation, right? Because those are not necessarily things they need, they're wants. And so this is another plug for making your property stand out, making it the best property it can be right now, getting lots of really loyal people who will repeat visit, right? Collecting that email list, making sure that you are able to reach out to them yourself because you have their email 6 months from now and offer them a little bit of a discount to come. And if you're in a vacation area as well, just think about like what can you do to shore up your portfolio overall? Because one of the things we think about is, we have a pretty large, substantial portfolio right now. If one of our properties has a time where it doesn't do as well, we can cover those costs with our other properties. And so make sure you have reserves or make sure you have other properties in your portfolio. If I had only vacation rentals in one vacation area, I'd be a lot more nervous than if I had a mix of properties in multiple cities across the country, because I know that I don't have as much concentration risk. So think closely about your portfolio mix and also about optimizing that current portfolio performance so that you can weather the storm. If this continues in real estate, if we have, if prices don't increase for the next 3-4 years, you want to be able to survive that, right? And you want to be able to hold your properties.
Now, something else I think is really important to bring up, and this is based on my experience back in 2008, is if you're going to be going out there and buying properties, you really want to think about the term of the loan and make sure that you're locking up a longer term loan, right? Ultimately, what you're hedging against and protecting against is that interest rate going up. Now, if that interest rate goes down, then you can always refinance into something lower, right? But what you're really protecting against is the possibility that interest rates go up, because if that were to happen, then it's going to make it very difficult to sell for a gain. And more likely, if interest rates go up severely, then you're probably looking at selling at a loss.
Yeah, so the reason that so many people are in trouble in real estate right now is they had short-term loans. They had short-term loans or they had loans with floating rates, and they now need to refi, and all of the values of the properties are down. And so they're going to the bank and they're saying, I need a cash out refinance. But the bank's saying, well, your property is worth like 15% or 20% less than it was when you purchased it 3 years ago or 4 years ago. You need to come to the table with money to get a new loan. And that's part of why people are getting in trouble. And so let's think about how long this real estate recession can last. Will it last 3, 4, 5, 6 more years before property values get up to where they were in 2021? We don't know, right? Nobody knows. People can always predict, but the truth is nobody knows. I love to see how many people are always like, oh, the interest rate's going to go up, it's going to go down, this is what's going to happen. I follow Oak Tree Insights, which is Howard Marks' newsletter. It's so valuable. And he's always talking about actually nobody has any idea. People are just completely guessing. So we are very thoughtful about never guessing, because it truly is a guess. And we don't want to stand here and say we know what's going to happen. We don't. But what we do know is if you have a 7-year loan, you have a lot of flexibility. You have a lot of flexibility that unless something doesn't change in the next 7 years, you're going to be able to get a refi. If you have a 3-year loan, you have just given yourself a really shortened timeline, and you're hoping within the next 3 years that things don't get worse. And if they get worse or they don't, or they stay the same, you're not in a better position. In fact, you could be in a position where your properties maybe even lost some value and you now need to get a new loan. You don't want to be in that situation. So when we go to get commercial loans, because of what we learned in 2008, we're always aiming towards those 7 and 10-year loans for commercial. Now, obviously for residential, you're getting a 30-year loan. Great. You're going to be okay. Don't get a floating loan, right? And think about the ARM if you're getting an ARM to make sure it's a longer ARM. But, with commercial properties, we're really mindful to give ourselves the most flexibility. What that means is you'll pay a slightly higher interest rate. But for us, it's been worth it because we watched what happened in 2008, and Kenji experienced what happened in 2008 when you don't have the time you need to be able to let the market conditions shift and be able to get a loan that works anymore.
Yeah, and something along those lines is that there are a lot of loan assumptions out there. And so something you're going to want to watch out for too there is not overpaying for a property, right? Don't pay for that interest rate. Make sure that you underwrite it for today's interest rates, for example, to make sure that the deal still works for today's interest rates. Because if you're paying for that lower interest rate, The problem is when you have to refinance, then it's going to be very, very difficult to sell for a profit in that situation if you have a doubling of interest rate over the rate that you bought it at.
Right, and if you're doing a loan assumption and it's a really great interest rate, but it's gonna start being a floating interest rate in 2 years, like be very mindful of that, because that's the same as being in a situation where you have a very short arm and you're gonna be in a situation where you're gonna be tight. You're gonna be in a really tight spot, and like, are things gonna be better or worse? None of us really know. And so you're just gambling.
Yeah.
Straight up gambling.
Yeah, the way I like to think about it is like, you have a runway for a plane to get off the ground. And so what you want to do is you want to give yourself as long of a runway to get that plane off the ground. And if you think about some of these properties, it's like, it's literally turning, it's a turnaround project, right? So what you're trying to do is you're giving yourself enough runway to get that property off the ground and into a better situation. And that's why that long runway is really important, because again, like as Leti said, you don't know what's going to happen. And so the longer the runway you have, the more you can weather different storms.
Mm-hmm. And we've been talking about, improving your current portfolio to make it optimized, make it perform better. But another part of that is also cleaning up your portfolio, right? If you have some properties that just haven't performed, the cash on cash is much less. Maybe you have some properties that are cash on cash negative, and you've already tried to optimize them, right? And you're at a point where you're like, what do I do with this? I don't know that I'm going to be able to improve it. It might be the time to sell, right? It might be the time to get rid of those properties, because there are opportunities out there that are great right now. Yeah, maybe you're going to take a hit on that property, but maybe you can shift some of that money and now buy another property at a discount. And it takes away the sting a little bit. Again, we always aim to optimize the current properties we have and not be in the situation where we're going to sell a property just, and it's bleeding. But sometimes you do it. Sometimes you just say, this property takes way too much time. I don't believe in the neighborhood. It's going down the wrong way, or it's cash flow negative, and I just got to stop the bleeding. And so this is a property I'm going to take a loss at, and I'm going to just take those funds and I'm going to put it into another really great deal. Then I'm going to have that immediate appreciation and forced appreciation and all those other things, and I'm just going to cut my losses and move on.
Yeah, you can do the analysis, but I think in most cases, if you find an incredible deal and you have a property that's just languishing, it's going to be much better to take that equity and put it into a better deal rather than just let it sit there in that languishing property, even if you're taking a little bit of a loss. Again, there's not investing advice, but just do the numbers yourself and see. But if you, again, find a great deal, and that's the whole idea here, is that we're in the middle of a downturn and there are great deals out there. Assuming you get that great deal, what you probably want to do is take that equity and put it into something that's performing, that you're able to buy at a huge discount.
And that's what we do, right?
Yeah.
Right. It's I mean, you have to ultimately make your own decisions, but that's what we've tended to do over the years of investing together. We've had a couple properties that were like, you know what, this property is just not a property we want long term. It's not doing as great as we thought it would, and we have another great opportunity over here. Let's just cut the losses, right? Let's cut the losses and move on and really focus on buying something that's going to cash flow well and give us more tax benefits and all those other things. And we move on. Don't win everything, every single deal as a real estate investor. The goal is to win the majority of the time. When we go to a finance conference every single year, and one thing they talk about is asymmetric risk reward, which is setting up deals where you can, even if you lose most of the time, you actually still win. Now, as a real estate investor, I think that you can win most of the time. There will be some loss. Sometimes you don't win. But in asymmetric risk reward, they talk about how really phenomenal investors set themselves in a way that if they lose 4 out of 5 times, they still break neutral, right? And as long as they win that one time. So they're setting themselves up with really bad, percentage losses, they're still going to be okay. As a real estate investor, I think it's actually much easier than that. I think that there's a way to get to the point where you're winning almost all the time, but you will sometimes have those ones that you just are like, I'm done.
And if you do, like I said, rebalance that portfolio, get rid of some of those properties and put that money into something else that's working.
And remember, it's a learning experience, right? And they're just like Jeff Bezos sometimes downsizes the business and fires people. Like, everybody goes through times where you make errors and you learn from them and you move on. And that's just part of what you need to learn as investors. Okay, we wanted to remind you we have a newsletter called Investor Insights at Semi-Retired MD. We would love you to go and subscribe to the newsletter. You can find that at semiretiredmd.com. to follow and get insights from us every single week on real estate and on life. And join us in the next podcast. We'll see you there.